Hello, hi everyone. Thank you so much for the introduction. And this is Sue, and I'm very happy that I have the opportunity to actually share my thoughts for the last couple of years, especially during pandemic and what happened and what has been done right in Silicon Valley, especially with our portfolio company over 260, and I've been doing this for over almost 10 years, and we actually invested a lot of the greatest company in our century and in their early days. So basically, previously I actually worked at the Stanford, and I wanted to start my own company and started to pitch to a lot of the investors in the valley, and I got to know the first Chinese guy at Google. He actually started the Google image search. And then you all know that Google actually started year 2000. Well, the internet bubble burst, which actually were one of the largest downturn in our century. However, because of because of the traction that Google has, and because of the downturn that Google actually enjoyed by getting all the talents at a very, very low price. So one of the things is Google has a really impressive milestone. So Dr. Chu, he actually joined Google year 2000 as he was still finishing her dissertation at UC Santa Barbara in computer science. And then his advisor actually went to Google and told them that this small company called Google was taking off. So I mean, when you actually see the real traction, you actually ignore what's going on in the macro economic environment. Like no matter it's a downturn or it's hype, Google back then only around for 2 years. Every day they have like almost a million ads revenue. So I would say if you have insights in a company and you met your milestone, and you don't have to worry. So that's the fundamental. Going back to first principle, what is burn rate? Burn rate is your cash balance divided by your monthly burn. We all know that, right? So first of all, you want to say your income. So company like Google, even though it's in downturn, however, they have a solid growth, and then that's all it matters. And also, a lot of the company, they actually raise a lot of money when it was a hype. For example, in maybe 2014, 2016, there was a lot of, LA, Los Angeles actually had a chance because back then, a lot of the investors, they wanted to catch the next Oculus. Oculus was acquired previously by Facebook. So a lot of the company actually started, virtual reality companies started in between 2014 to 2016. And that was really good. However, in 2016, the bubble burst, and AI became a hype. And then a lot of the company, they realized that, oh my gosh, I only have a story, and then I don't have a real solid cash income. So that actually became very, very difficult for those virtual reality startups. So we all actually experience that, right? So in Silicon Valley, we say every 18 months there is this new hype. So meaning that the previous hype was actually became a bubble bursting event. So that means, bubble is great. We need bubble. Tech bubble is great because it actually solved the supply problem. Because as an early stage investor, we need the supply. We have demand to invest in more company, and hype actually drove a lot of really talented professors from Stanford, students from Stanford, top engineers from Google, and they wanted to they thought, oh my gosh, this is something that I was trained for, and then because there is a lot of money pouring in, and then I can start my own company, right? So hype is good. However, so once you raise money, you only have 12 to 18 months, right? You have to burn those money. and then you have to meet the next milestone. This is your time window with only a story, which can actually, give you a lot of the runway, 12 to 18 runway, which is also your time window. So at this point, especially economic downturn in 2022, now a lot of the bubble bursted, and the story is definitely not enough. So you definitely need really solid numbers. And then if you don't have those solid numbers, unfortunately, you have to cut down your burn, your monthly burn, to extend your runway. So that's something that we really want to talk about today. And so my own story, I actually, experience not just the, virtual reality 2014 to 2016, and then AI 2016 to about now, right? So, and I think for crypto, it's the same thing. So when we first invested in crypto, that's 2014. So between 2014 to 2017, you would think a lot of the companies, actually Bitcoin was actually at a very, very low price. And then a lot of the company, very talented people, they actually want to start a company with real utility, taking advantage of blockchain technology. And then they couldn't raise money. So when they talk to Sand Hill VC, and then in 2014, a lot of the VC will be like, oh my gosh, crypto company, no, I don't want to invest because I lost a lot of money in the previous bubble, like between 2010 to 2014. And then I invested in a lot of a Bitcoin mining machinery company, exchange, and they all went busted, right? So I don't want to touch crypto again. That's definitely a very, very bad downturn in starting from 2014. However, what happened? We actually have to create a blockchain university to actually help those companies to actually meet their milestone, to actually work on their milestone, work on real traction, build research papers. And then one of the guys actually in this picture is Vitalik. So back then, Vitalik is actually one of the instructor of blockchain university. He tried to actually share the beauty of Ethereum and let everybody to issue tokens, ERC2 token, right? ERC20 token. And then the guy that in the very left, the second to the left, and then he was actually the guy that incubated the Dfinity, which actually the research lab of ICP, behind ICP, one of the $1 billion market cap crypto now. And then, so this is something that actually a great time for you to build, because whenever there is a downturn, and then startup and founders still came out to do a startup, work on a product or technology, and then it actually really shared a signal to the investor that they have real traction, or they have something that they actually would like to build for their customers. That's the beauty of real entrepreneurship, because oftentimes the best scenario is, oh, I'm building something and I already have customers. I still work at Google, or I still, a student at Stanford, and then I don't want to, but I have to start a company to serve my users. That's the best scenario, right? So that kind of scenario, you don't have to worry about downturn. So I really respect those companies who actually created by tech people. The reason is they are makers. They're like they can just make things out of their computer, right? So they don't need a lot of investment. They can pivot really fast. So at the economic downturn, we actually saw tons of products and companies coming out because they have real customer, real user, and then they have to start a company to serve them, no matter what happened in the secondary market, right? So that's the first principle. Why do you want to start a company? What's the reason? Because you already have customers. You wanted to serve them very well. And so for a lot of the company that Amino invested, the most successful ones are in 3 categories. One is consumer. One consumer is super difficult, but if you are a hit, you are winner takes all kind of scenario. So it can be really, really big. Now, or a really good business model is PLG SaaS, product-led growth SaaS. The look and feel of the company, it's like a consumer internet product. However, you have paid real user because your business model is SaaS. So your users can be SMB or even tech giants. But the barrier for customer onboarding is really, really low. And not just Amino investing in this field, VC investing in this field like crazy these days, but also secondary market gave them very good PE ratio. So like Zoom, at one time it was like 100 billion market cap, which was unheard of for a B2B product, right? So it's almost like a valuation of Coca-Cola, which is like home brand. So this is some business model that I would like to emphasize, because we not just we have this home brand unicorns, but also we actually have observed a lot of the companies, for example, like Webflow, right? So Webflow, before they actually raised Series A, they were already profitable. They were profitable for many, many years. And then for company like Webflow, do they have to raise the next round? It seems like they don't, right? Because their revenue is indefinite. Their burn rate is indefinite. However, I would say a lot of the companies like PLG SaaS, you also have the time window problem, because a lot of the SaaS products you're building, so it can actually be a feature if tech giants already figured it out. So you don't want that to be happening. So that's why you want it to be a marketplace. You don't want it to be a feature that somebody can just offer for free, right? So you don't want to be just a tool. You want it to be an ecosystem. So that is what happened with Webflow, with Zoom, with Rippling. So they're not just a tool. They actually became a marketplace. They became a super app. They became integrating in everything. So I think that's value-added services can really interrupt the existing business. So that's how you became a unicorn. And then meaning that you have to invest in more in research, investing more in more like product development, new experiments, then you wanted to raise money to achieve that. Then you have a goal. So before you have a goal, you're profitable, it seems like you don't want to raise money. However, once you have a goal to meet your next milestone, once you know how to spend money, and then you can confidently raise money. So in our portfolio, we actually watching a lot of the company. They haven't raised Series A, but they are kind of like almost profitable, or a lot of them are already profitable. There are 30 of them. So I think the most difficult thing is to convince them to actually raise the next round. And then we figure that we do have to help those companies to develop a strategy to actually from a product, from a tool to a product, to a ecosystem, to a platform, which can actually upsell other people's products and eventually became an ecosystem. That's actually, something that the founder who actually have early success have to think about. So choosing the right investor with a good strategy is something that I think both we as a venture capitalist and also founder, we have to work together on it. So that's actually the beauty, the fun part of helping the company. And then the third category is frontier tech versus Web3. So this is the most risky type of a business model, and when there is economic downturn, right? Because from the reason why we put Web3, as part of the frontier tech, because they share the same common kind of like a practice or common characteristics. One is that you have to have the best team in the whole world. You have to have the best team in the whole world because you are in this frontier tech. So if there is any, certainty in your field, it has to be your team. So best team, right, in the whole world. Second of all, you have to have a very certain, promising product. You wanted to define that product very well. So take example of Gorilla. So Gorilla, their problem is defined very precisely. So they are actually aiming to screen for 50 different cancer using 2 cubes of blood. So, and then they are taking advantage of Google machine learning algorithm theory to actually compare mutation with diseases. And once they train the model, and they can actually take a so-called healthy person's blood, and then using their algorithm to find whether there is mutation, and then which can be correlated to certain cancer. Very well-defined problem. Dfinity, very well-defined problem. They wanted to be faster and cheaper version of Ethereum. And then they also have a really awesome ecosystem. And a lot of people, big or small, individual or enterprise, are actually enjoying their ecosystem. So they have a lot of the key people, actually community people, actually taking the lead to make certain decision for approval their token economics and getting rewards back. So I think that's a very well-defined high certainty in their layer 1 chain. So the third, so even though you have the best team, your problem is very, very well defined. The best team can actually execute on their product, and then it's not enough. So you have to have a really clear path to liquidity. So even though you're not profitable or your layer 1 still have no killer app, but there is a very clear way for this product or this company or this project to have secondary liquidity events. Like Gorilla, before it was acquired for $8 billion by Illumina, actually Gorilla was filing IPO in 2020. And Dfinity is a Web3 layer 1 project, even though they're still growing. However, in 2021, they were listed at the coin marketplace, direct listed. So investors can enjoy the liquidity promise. So for such kind of business model, it's a little bit difficult in the downturn because you don't have solid cash incomes, right? So, or you don't have a real utility. You don't have a killer app on your layer 1 yet. So I would say for such team and product, this is the time because you already liquidate, right? So you already have liquidity events. So you don't really worry about downturn. So what you're doing during downturn is to really build stuff because there is no trading. There's not much trading activity anyway. So you wanted to work on research and development. And that's exactly what's going on for a company like that. And then there are companies, of course, unfortunately failed. And you probably heard these days that Argo.ai, which is a Star autonomous driving company backed by Ford and GM, which actually went bankrupted, right? So same thing. So they are in this category of frontier tech, and they didn't actually went public successfully, like a cruise, right? Or too simple. So they're fine because they already liquidate. They're already a public company. And then even though their PE ratio is really low, their market cap went down so much, but they still doing okay, right? So because they already have the liquidity event. But a company like unicorn, like super big unicorn, like Argo.ai, so they couldn't raise the next round, and then they failed. The company failed. So it's so important. If you have a frontier tech company or Web3 company, you want to think of liquidity. So I think for people, when you actually think of meeting investors, right? So it's really something that in Silicon Valley is really something that the people very open-minded. And then I think it's not so important how you get the pitch. You get to know the investor through who. And I think it's important to actually find a good fit. And for Amino, for a lot of the investors right now, they are very sophisticated. And for Amino, we have an internal system. So all the companies have to go through our internal system, and then we can actually generate a due diligence report automatically. We don't need analysts or associate to generate the report for us. So a lot of the, especially during pandemic, we actually became more efficient. And then we only, before, if we go to events, and then we have to talk to the first person that we met at the event for maybe, a couple minutes or tons of minutes. And then we don't even know who that person is. But because of the digitalization of VC, we actually know exactly who that person is before we started the conversation, because we know their LinkedIn, we know their background. We can check their GitHub. We can check how many, how much contribution they are into those open source projects. And then so nowadays it really doesn't matter how you know the person. Like I responded to my LinkedIn messages a lot, right? So that's totally cold contact. And then I met people in, downtown Palo Alto, in coffee shops, in flight, or some products I had never known, but my husband or kids are working on or using anywhere. So if you like a certain investor you want to reach out to, I encourage you just email them. And then I think it's really something that, due to digitalization during pandemic, VC became smarter and smarter. Okay. So I would say the best way to extend your runway is actually to prepare next round financing as soon as possible. Because oftentimes you are actually in this, milestone dilemma, right? So you have this milestone, and then also you're growing. However, a lot of the CEO, they are not actually getting used to looking at their QuickBook all the time. So we've seen CEOs, they actually didn't pay attention to the employee income tax, and then they own IRS a lot of money, but they were not able to take that into account. So suddenly they have this really, tons of thousands of dollars and owing to the IRS, right? So the tax agency. So suddenly your runway is shortened by 1/3, and that's not good. So I think by focusing on milestone, and then you actually learn the growth, which is great. But in the meantime, you also wanted to actually develop a habit to actually check your cash balance in a very kind of like a disciplined way. And then you can actually know your cash balance when it goes to 0. You definitely wanted to raise 12 months prior that time. So then you have a calculation here. when do you think your cash balance will be zero? Even though you have a very solid cash, like very solid growth, you still have to think about the cash balance. And then that's your runway. And then you wanted to start to raise money 12 months before your cash balance is zero. So that's very, very important. And when you talk to investors, and they wouldn't actually ask about burn rate, if they ask, if it's too short, definitely it's a very bad signal. You send a very bad signal. But a lot of times, the investor most interested is the growth rate, especially for growth stage company. So if you actually enjoy, like they have during pandemic, right? So they have 600% year-over-year growth. That means that the growth stage investor, they give you money, name your unicorn, and you can actually do this again. You can copy the same model in other regions, in Canada, in East Coast in the US, and then also you can actually kind of like expand vertically. Instead of just Asian American grocery shopping, you can expand to Hispanic, you can expand it to, Russian and Russian American, European stores, right? So you can extend it to so many different languages. And then they felt like, okay, you nailed the Asian American grocery shopping, and then you just have to copy it. That's why I named you unicorn. That's why, we now is already a $4 billion company, because they did very well in terms of expanding to Hispanic, into Vietnamese, to Japanese, Korean, many other ethnic groups in the US and Canada, East Coast, all around the US. So the growth rate is something that we wanted to pay attention to, because if you're a growth stage company, your growth rate is over 200 year-over-year growth, and then that's a really good sign. You're ready to raise money, even though you're not profitable or your runway is pretty short. I think you still have a really good chance. It's a really good chance to talk to people and then to get it ready, to choose the best investor. That's our time window. So I think a lot of the company actually in the US, they actually became unicorn, or they enjoy really big raise, are in those very specific, very interesting space. Like Chime Bank, they're in, the fintech space, and they're the neobank. They're the first front runner of neo banking. And also Definity is Web3, and Gorilla is healthcare, and Rippling is PLG SaaS, and we is consumer. So it's always in this sector that actually have been, incubating for many, many years. And then the COVID-19 pandemic event happened and really triggered the company, which has been around for a long time, and they're ready. And then next thing you know, the pandemic event hits, and then they are the most mature products that people can enjoy. So I think it's so important that not really to, to actually catch a hype. So you wanted to be a couple years before the hype. And when the hype actually came, and then you're the most mature company. That happens to all of our companies that are actually doing very well now. So meaning that even though there is economic downturn, you can actually work on something you really trained for and passionate about, and have real traction, real customer. So I think my time is up. I just want to say that I think Hong Kong is really, we actually enjoy working with Hong Kong government and also Hong Kong events at Cyberport for many, many years. And I personally actually, went to Hong Kong Dragon 100 delegation back in 2008. And then one of the, delegation in our group is Michelle Wu. And he later on became a mayor of Boston. That was very awesome. So I would say, Hong Kong is really a gateway to actually bridge, US and China. And it actually enjoyed the capital, liquidity, as I mentioned, and the GBA and land. And I think Amino, we actually, follow the talents. So if they wanted to start a company in Hong Kong, and we definitely support them. And matter of fact, recently we actually invested over 20 companies, returnees from Silicon Valley to Southeast Asia, including Hong Kong. So I think it's really something that I wanted to continue the conversation. Yeah, thank you so much.